This is urgent. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, you need to sell this by Friday as traders are aggressively dumping this sector. I'll show you what's coming on Friday and why they believe a crash in this sector is imminent. But we'll take a look at the incoming economic data and attempt to determine if they're going to be on the right side of the market or not. And so you know what that means. It's time, and yes, you've been waiting for it. It's time to get out now. Let's head over to Bloomberg, where we picked today's story up with a headline: as traders unwind long treasury bets as smaller rate cuts are weighed. And this is important to understand because we've seen a rally in the long bond recently as expectations of further rate cuts and large rate cuts start to mount up in the market, everyone wanting to also be on the long end of this trade, because when short rates go down, long rates tend to follow them. And when you understand duration and trading, there's money to be made at the long end of the curve, and traders started taking big bets on this, but something has changed their mind and in a big way, and it's coming on Friday. Let's talk about what they're up to, because traders are pricing in about 33 basis points worth of easing at the next Fed meeting when they announced their policy in November, implying a slightly lower but still solid chance that officials opt for a second straight half-point cut. They see some 69 basis points of reductions before the year end, compared with about 70 before the data. So what we're seeing now is some data that's coming out is spooking these traders into believing that maybe the economy is going to achieve the soft landing or no landing scenario, but we're maintaining the view that the Fed is going to aggressively cut in November and December, and what this is creating is a potential opportunity for other people to take the other side of this trade as investors here look for opportunity and traders look to aggressively sell this sector. Of course, the question then, what is coming Friday? We'll look at that in a moment, but let's talk about the Fed's position here and why I think traders have this wrong. Because when we look at the federal funds rate in blue against two-year treasury yields, the reason we look at two-year yields that are shown in red is because they really give you a strong direction of policy rate from what the Fed's going to do. In fact, if we just set the federal funds rate based on the two-year yield, we would get nearly the same outcome. And you can see, looking in the past here, the red line leads the blue line, which is again the funds rate lower. And when we look at the two-year yield right now, you can see that first rate cut barely even made a blip on all of those rate hikes going up, suggesting that the Fed is more likely to do a 50 basis point cut than a 25 basis point cut, simply because the market is telling it to. But what spooked traders today, what's caused them to pull off those long bets and start positioning for a big move down in the long bond? Well, that has everything to do with U.S. hiring as the ADP data rebounds after 5 months of easing. Check this out. Private payrolls rose 143,000 in September. That was well above forecast. And one thing we know is that Friday the non-farm payroll report comes out, and it tends to be even bigger number than what we see from ADP. So all of a sudden now traders are saying, wait a minute, maybe the U.S. economy is stronger than we thought, and this will put the Fed maybe to back off on that half a point cut, only go a quarter point, and then see what happens in December. We still think the base case is 50 basis points here. And some of the evidence we see right here in the headline is stronger hiring didn't require stronger pay growth. We'll talk about that in a moment, but something that is rebounding in a big way is our trade on uranium. This is one, if you didn't get in on this, if you weren't a subscriber, you missed out. As of Friday now, this trade is up almost 13%, and as of trading today, it's still going even higher. Now, if you missed out on this one, we have another trade that was a pair trade between our two reports that's breaking out. You can still get in on that. We have two things we do. We trade against the machines, and we do it very successfully. We also trade momentum. That's called Momentum Timer Pro, and our reports are so easy to use. You can get in before 2 hours before market open. We give you the reports. I also publish my opinions on all new trades. I give you the buy it open. You decide if you want to trade it, and then you add a stop loss later. Then you go about your life. You don't sit in front of your computer. Don't watch your phone all day. And then once a week, if you're comfortable, update your stop losses. When you get stopped out, you profit. Here's what you get. You get the daily reports, the tradable signals, my opinion on the best trades you should do. We have backtest data and more coming, stop loss levels, full tracking of trade and returns, and updates on the stop loss levels. And here's the best parts. Not only do you get a 30-day free trial, you can duplicate every trade we do with perfect accuracy. Links in the description below. Don't miss out on our next big trade. Again, it's taking off right now. Let's talk about wage growth in September. It's cooled off, and this is something we've noted was likely to happen because what are we seeing in the economy? Demand is going down, and when demand goes down, well, employers don't need as many employees, so they send them to the unemployment line. Now, from the Fed's perspective, the unemployment rate is at where they want it to be, around 4.2%. They don't want it to go higher, but one of the problems here, when you start putting people on the unemployment line, the reality is employers say, wait a minute, I don't need to give you a big raise because if you don't want it and you're not willing to accept what we're willing to give you, well, I can just go get someone off the unemployment line who will probably work for less, and that does put downward pressure on wage growth. And for workers who changed jobs, earnings rose 6.6% from a year earlier, the slowest pace since April 2021, suggesting if you want a pay raise, you got to change jobs. But of course, that comes with risk heading into a recession. Pay gains for those who stayed in their current position eased slightly to 4.7%. As stronger hiring didn't require stronger pay growth last month, typically workers who change jobs do see faster pay growth. That we've known, but there is a risk, as many of you know, because if you change jobs and there's a downturn, it's usually the new people that are the first to go. This is why now we're seeing people start to stay at their job and take a smaller pay raise. But let's talk about why, again, we go back to seeing the slower payroll growth in terms of earnings, and it's everything to do with the unemployment rate. As we look at total income, which is the function of average hourly earnings multiplied by average weekly hours of production of non-supervisory employees, and that's shown in blue on a year-over-year rate of change against the unemployment rate. And what do we see as the unemployment rate rises and there's a greater availability of workers in the employment pool? What do you see? Employers say, look, I don't need to give you more hours, I don't need to give you big pay increases, and you see that relationship. It's not quite a mirror, but you see there is a very strong relationship between the two. This time we see the unemployment rate start to bottom and head up, and employers are saying, look, we know you need big raises, we know inflation is hurting, but we don't have to do it because the slack in the labor market, well, it isn't really there. We're starting to see a lot of people move to unemployment. We're seeing hours get cut, and that means employers do not have to give out big raises. And this is one of the reasons we look at what Amazon recently did by telling everyone it's time to come back to the office. What did that do? It spurred a lot of employees to say, hey, you know what? I don't want to do that. I'm going to go look for a job elsewhere. And perhaps that's one of the moves here. Amazon needs to cut some people. They don't want to do it. So they'll find out who wants to come back to work, and those who don't may not have a job much longer. As hiring was broad across industries led by leisure and hospitality as well as construction, information was the only sector to cut jobs last month as we find out the more high-tech jobs are going away. Job gains were also spread out geographically, which is good news, and firms with fewer than 20 employees were the only ones to reduce headcount. And this is dangerous because small businesses are the lifeblood of our economy. We want to see them doing very well because they're the ones that become mid-sized companies, and some of them eventually become large companies, employ lots of people. So when we see a slowdown here, particularly in demand, we know it impacts small employers first because they don't have the financial resources to weather a storm. So what we're seeing here is they're laying off people. It's a huge red flag for our economy. It's telling us that things are getting far worse. In fact, we have some anecdotal evidence of that as we get into the economic data here, suggesting that these traders who are looking to now turn and short the long bond heading into Friday's non-farm payroll report may be in the short term on the right side of the trade, but over the longer term, they're going to find themselves completely on the wrong side of that move. Let's talk about what's going on with the U.S. port strike as it is being backed by the White House. And what this means, my friends, is that strike is not likely to end soon. And this is going to do a severe amount of damage to the U.S. economy, particularly the longer it goes on. What you could see is more small businesses being forced to lay off. If they can't get the goods they need at the time they need it, that means they're going to be forced to cut headcount. There's no choice about this because you think back, what is something that we've heard from companies need? They need inventory for the holiday season. They ordered it in advance, hoping it to get here. Now a lot of it's going to be stuck on ships. The longer this strike goes on, the worse it gets for the U.S. economy. The ILA, which represents 45,000 port workers, launched a strike just after midnight Tuesday after negotiations with the United States Maritime Alliance for a new 6-year contract collapsed. The USMX has offered the union a 50% wage hike, but the ILA's fiery leader, Harold Daggett, said the union is pushing for more, upwards of 70%, including a $5 per hour raise for each year of the new 6-year contract and an end, this is a big one, to port automation projects that threaten union jobs. What it means is if they automate, there's fewer jobs, and this is something the union does not want to see. Of course, we know a lot of companies automate, and what is the big expense they're saving on? That's right, employees. Of course, the ports want to do this. The union says no. The risk here is, with the White House willing to stay out of it, this could drag on and severely damage the economy, perhaps enough to push us into recession. But Morgan Stanley said in late Tuesday that the strike could hit growth and raise inflation, but only if it's long-lasting. We're going to argue that last part of inflation, noting that the implication for transport should be limited unless the strike lingers, and right now there's no sign that it's going to end. But what would happen if we do see prices go up here? Because as consumers, take what's on shelves and out of local inventory and it goes away and there's nothing to refill it, what's going to happen is businesses are going to be forced to raise prices because of a decline in supply. But what normally happens in that situation when we already know consumers can't afford current prices? Well, here we can look at coming back to total income. Here we see that now in red on a year-over-year rate of change against the consumer price index. And when you see income growth slowing, as we did here going in the early 90s recession amid higher prices, what happened is you turn around and you get massive drop. That's deflation there shown in blue. You see it happen again during the dot-com bubble. And yes, it's just that simple. Businesses can raise prices, but if consumers can't afford them, you'll find out they'll be cutting them very quickly. You see that again going into the global financial crisis as oil prices shot up and consumers balked at that. Now the risk is we see inflation turn higher when we know for a fact that we're going to see fewer and smaller pay raises for those in the working class. That's dangerous because they will not be able to afford these higher prices. And we're already seeing evidence of that as we turn to Nike, who now seeks to wipe slate clean for its new CEO. But the company has postponed its investor day, and this is huge because sales in the first fiscal quarter fell 10% to $11.59 billion, just short of the average analyst estimate. Declines were especially sharp in North America. So we talk about the demand here in the economy, and so that's what really puts things aside here as we look at the ADP report and the potential non-farm payroll report, and we have to question the accuracy of this data because what we're seeing from companies like Nike is that no, the U.S. economy is not good. No, we're not going to see the soft landing because if you were, we weren't going to see a huge drop here, particularly in North America as well as Europe, Africa, and Middle East. While problems also persisted in the Converse brand. Nike expects revenue to fall 8 to 10% in the second quarter before trends improve. At least that's the hope, as everyone has, is that trends will get better. But the reality is this port strike could push the U.S. economy into recession. It's a huge elephant in the room here. But let's take a look at what's facing retailers. As we take a look at real retail sales, this is inflation adjusted data. That's shown in blue against total incomes in red again, both on a year-over-year rate change. And as income growth slows, and we know it's going to continue to slow because as the unemployment rate rises, well, employers don't need to give out raises. And what do you see? Real retail sales shown in blue, it declines each and every time. And what Nike's doing is giving us a little bit of expectation of what's to come here as we hit earnings season. And it's not just Nike. Here we see Stellantis U.S. sales plunge again in sign of deepening woe. And what you can see here, disinflation coming to the auto industry as all 6 of Stellantis' U.S. brands had inventory levels above the industry average of 77 days at the end of August. We just talked about in the manufacturing sector yesterday how manufacturers are building inventory to keep their workers busy. The problem is they have no sales, and that's an issue. You see this happening at a major car brand, and now Tavares, the CEO, is taking steps to clear swelling inventories. That means, of course, cutting prices, increasing incentives. That's disinflation, something nobody thought would happen. and reintroducing more affordable models because people cannot afford these higher prices models, like the entry-level Chrysler Voyager minivan. He's also cutting jobs in the U.S. and Europe and slashing capacity at American factories to offset declining sales. And this is something we've been warning about. As we turn to Texas here, we're going to come back to this capacity utilization because we're seeing it Stellantis and we're seeing it happen in Texas. And this is a dangerous sign for the labor market as Texas manufacturing activity slips in September, but production expectations remain solid. And what are the expectations? That Fed rate cuts are magical and they're going to bring a huge amount of demand to the economy. We know it's not going to work, but Texas factory activity fell modestly in September, according to executives. The production index, a key measure of state manufacturing, slipped to minus 3.2 with a negative reading, signaling a slight decline in output. So here you see the factory output coming out the door is going down, while most other measures of manufacturing indicated declines this month as well. Check this out. New orders index was largely unchanged at minus 5.2. So further contraction in the fax machine running at factories. The capacity utilization index fell 5 points to minus 7, meaning less of the factory is being used, and the shipments index retreated back into negative territory, falling 8 points to minus 7. Perceptions of broader business conditions remain negative September as a general business activity index had fairly steady at minus 9, while the company outlook index stayed negative but inched up. And of course, the outlook is that perhaps when the election's over, perhaps there'll be more Fed rate cuts, and next thing you know, consumers are going to run out and spend, but they don't have the income. And they're looking at the jobs market and saying, wait a minute, things are going wrong here. But let's talk about capacity utilization because it has a direct link with the unemployment rate. You see as less of a factory is being used, and this is shown as a percentage of the factory that's being utilized. Here we see that in blue. More people hit the unemployment line. They get stuck there because there's no jobs being created. You see that happen going into each and every recession, and now you see it happening again. Capacity utilization declining, the unemployment rate starting to head up, and all that means is traders that are betting on fewer Fed rate cuts perhaps are going to have it wrong. Labor market measures suggested some employment growth but slightly shorter work weeks this month. Again, another red flag. The employment index moved up 4 points to 2.9, and 20% of firms noted net hiring. And moderate upward pressure in prices and wages continued, notably likely prices moving up faster. The wages and benefits index ticked down to 18.5. Expectations for increased activity in the next 6 months from now went up to 35.2, which I think is nothing but a dream, because at what we're seeing here, when we look at the bond market, when we look at what traders are positioning, the long bond is all a function of growth and inflation expectations. They're looking to short it based on a payroll report, but when you look at the manufacturing sector, when you look what's happening with Nike and Stellantis and in, of course, Texas, all it tells you is growth and inflation is coming down in a big way, giving an opportunity for those who perhaps want to take the opposite side of these traders to make some money on declining yields. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.